is a presentation of TFNN. Live at TFNN, the Small Cap Roundup, with your host, Kate Stalter. Now, Kate Stalter.
Well, good morning, good morning. Happy Tuesday. And here we are again looking at small cap stocks. And one of the things that I like to do on this show is really to look at the small cap universe in the context of the broader market. I've put up a chart there, obviously, of the IWM. We look at that quite a bit here on the show, the Russell 2000. And there we go. I've just kind of refreshed it a little bit there. So, it's so interesting to me. And one of the things that I'd like to talk about with some of the guests that we do bring on today would be the idea that, you hear, it was kind of funny to me because yesterday I did hear a couple of different analysts on television. Actually not in the same segment, but, one guy was saying, well, the small cap trade is just completely dead. You want to get out of there. The next guy was saying that's where all the growth is going to be. So, it just really doesn't make any sense to listen to all these various opinions. The people that I like to bring on the show are the ones that have done the research. I'm a chartist myself, and that's, if you're new to the show, that's one of the things that we will be doing on here, is taking a look at a lot of the charts using some fairly simple technical indicators, price and volume, moving averages. I tend to keep even the moving averages pretty simple, and it's been a very successful way to just take a look at what are some of the leading stocks in any market situation. For example, the 10-week moving average, the 40-week moving average translates to the 50-day or the 200-day. So those are a couple of the things that I do tend to use, and just I like to look at some pretty simple chart formations. So that's the kind of thing that we do tend to do on here. So just to give you a little bit of a sense, excuse me, of what it is that we will be doing on this show. And as I set up earlier in the show, when I started kind of speaking a moment ago, one of the things that I like to do is to not look at the small cap asset class or any asset class in a vacuum. So we're going to be looking at that whole theme today. Now, we have right now a guest on the line who I'm thrilled to speak with. Last month, as I've mentioned a couple times on the show, I was at the World Money Show down in Orlando, Florida. I had the privilege of being able to meet and speak with Marianne and Pamela Aden of Aden Research. And I understand we have Marianne on the line. Marianne, it's so great to speak with you. Welcome to the show.
Oh, thank you. And it's really a pleasure to be with you.
Yeah, glad to have you here. I really, as I've mentioned to you previously, I really did enjoy your presentation, and I appreciate the way you blend fundamentals with actual chart analysis. And if you kind of heard me speaking there a moment ago, the chart analysis is something I talk about a lot on the show. It's one of my own investing methodologies. And the TFNN audience definitely also appreciates this. Now, I liked a quote that I saw on your website. We learned long ago not to argue with the market. I just love that. And I know that isn't that great? I mean, that's just so perfect. And so many people do the opposite.
It's very, very true. And it's really, really great to be on your show as well. And I just wanted to say we enjoyed meeting you very much. And what you say is true, is that when you can combine the fundamentals with the charts, it makes all the difference. And the markets do always tell the story, and that's what you'll see in the charts first, and then the fundamentals will fall out later. And I don't know if I interrupted you there, but a perfect example, I was just thinking about this yesterday, was if you'll remember how gloomy things were last November, December, as far as the Greek situation, and was it on the brink, and was it going to take the whole world down with it, and the whole thing, it was just looked like perhaps another 2008 repeat. And then suddenly, in that gloom, which is usually the case, stocks started to spurt up, and a lot of people just doubted that it was real. It was fake. They thought it was a fake breakout. A lot of the international markets were not confirming what we were seeing in the Dow Industrials and the U.S. markets. And sure enough, now we see a few months later that, yes, things are looking a little better. Yes, the recovery seems to be, it has a little bit of tread going to it. Now, yesterday, Bernanke says that they're probably going to be, adding a little more liquidity, and stocks surged up higher. Now the international markets have joined in the last couple of months. So now it's obvious but this is something the markets were telling us months ago.
I like something you said a minute ago about people wondering at the time of when the new uptrend began late last year, people wondering, is it for real? I saw something on television yesterday on one of the market channels where they had a little chyron running across the screen saying, is the rally for real? And that, I remember that happened after March 2009 as well, that into the rally.
It sure did. It was exactly the same thing. And you do have your doubts. It's not like you just, there's always going to be some doubts when you go into a market like that, which is usually the case when you go in near the bottom. But then it just, and I don't know if it's just experience or what, but finally you do learn to just trust the markets. And if they're telling you full steam ahead and they're giving most of the clear signals that are consistently, that work consistently, then you just go with them.
Now,
sounds
one of
a
the
little
things
simple and trite, but it works.
Right. No, you know what? And it's interesting. I don't know whether you know a gentleman named Jim Rohrbach. We had him on the show about a week or so ago. And, we had some similar conversations. I agree with you. It's the trend following, and like you wrote in your newsletter, not fighting with the market.
Exactly, because you can fight, and I know people that do all the time, and we've done it ourselves. I mean, heck, who hasn't? It's just, you could go, oh, no, that can't be because inflation is too high, or the recession's too deep, or this is too this, or the Fed's been pumping too much money in. Why would bonds go up? You can fight and argue about everything, but if you just kind of learn to go with it and accept it, and then literally the reasons why do become obvious in time.
Now, let me kind of just ask you a little bit about the definition of the market, because I know for a lot of people they tend to only mean equities, but you cover a lot of aspects of various markets, equities, bonds, precious metals. Tell me a little bit about maybe how you view all of those and synthesize that view. Is that possible?
Oh, sure. Well, when we say the markets, we do mean all of them. And that's the interesting part, is that because they're all kind of linked in one way or another. So when most people talk about just the markets, they do mean the equity markets. I agree with that. But, the bond, it's kind of like the thigh bone's connected to the knee bone kind of thing. Everything is connected. And you can learn a lot about where stocks are going, for example, by looking at gold or by seeing what bonds are doing and so on. And so we've incorporated a lot of those studies into our work, and we try to take into account as many different factors as we can to help us kind of fine-tune which markets do look best and which are most apt to outperform and that sort of thing.
So let's drill down into that a little bit then. How should retail investors be viewing this entire picture? Because for a lot of people, frankly, they haven't had a lot of time to understand too much besides maybe just equities. So what should they be doing?
Well, for starters, this is that's kind of a tough question, but I would say for starters, it's if first you stand back and you look at what we call the big picture, and that is what's happening, what has happened, and where are we in the big picture, and economically, historically speaking. And basically what's happened, which would explain why gold is going up, is that there's been so much debt and money and this isn't just in the United States, it's all over the world. So there's just an overflow of debt. Everybody's kind of keeping their heads afloat, and that eventually could be years from now, but that's going to fuel some inflation, and probably big inflation. But for now, there's been a lot of deflationary pressures because of the recession since 2008 and what have you, and that has just kind of held that down. So it's kind of like putting a top on a boiling pot, so to speak. And that can, as you know, these things always take a lot longer than you think. So that's sort of it's very simplified, but that's basically why the gold price has been rising. Now, if you move over to stocks, they've been going up because of all that liquidity. And normally you'd say, well, shouldn't that be bad for stocks? Well, in a normal, healthy environment, it would be, but at this point, the market views that as, hey, more money, and more money available kind of floats everything up, meaning housing prices, stocks, even though housing prices haven't yet felt it, but eventually they will. Everything kind of floats up, including equities, and that's a good thing. And as for bonds, a lot of people think, well, if gold's going up or stocks, then bonds cannot be. But, for the past year, bonds have done very well. Last year, I think they were the top performing market, and that's because, again, in spite of the undercurrent being inflationary, the overpowering megatrend has been deflationary, which means, declining prices. There's no risk of inflation, and that's a very good environment for bond prices. So that's why bond prices have been going up. So that's what I mean by how it all kind of links together.
Right. And that's why it is always so interesting to me when somebody gets out there and kind of tries to look at just one part of the market in a vacuum. So I thank you. That was a great explanation. I think we're coming up on a break here in just a few seconds. So let me ask you this, Marianne. Could you stick around for the next segment? Would that be possible?
Oh, sure.
Okay, great, because I want to get a little bit more into some of the precious metals. I know we exchanged some emails about that. So hang on the line. We've got Marianne Aiden from Aiden Research on the line with us. Stick around. She will be right back for one more segment. This is the Small Cap Roundup.
You take a hands-on approach to managing your investments, and whether you're bullish or bearish on U.S. Treasuries, the ETFs from Direction Shares are there to help you seek to maximize your returns. Bull ETFs for a rising market and bear ETFs for a falling market. Direction Shares gives you the tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foreside Fund Services, LLC.
TFNN is proud to bring you the cutting edge of investment newsletters. Ken Shreve's Ultimate Growth Stocks. Ken is a top-down investor who lets price and volume in the major stock indices tell him when to be in the market and when to be out. By using his unique blend of fundamental and technical analysis, Ken will protect your hard-earned capital while realizing breakout gains. Go to TFNN.com today, click Investment Newsletters, and get Ken Shreve's Ultimate Growth Stocks free for 2 weeks.
Hi, I'm Steve Rhodes, co-host of The Money Masters with Tom O'Brien, seen daily at TFNN.com, author of Mastering Probabilities, a daily investment and trading newsletter, and teacher of The Money Game. Studies show that 3 out of 5 people are afraid for their life in trading these markets, and the number one reason given is fear of loss. Look, fear stands for false evidence appearing real, and the money game proves it. Lesson number 1, don't risk more than 1% of your trading capital on any trade. Why, you ask? Because 35 trades in a row where you risk 50 cents and make $1 are all you need to double your trading capital, versus the 230 losing trades in a row you would need to bring your balance to $100. Let me teach you more about the money game risk-free for 30 days. Go to the homepage of TFNN.com and click on my name, Steve Rhodes, for your 30-day risk-free trial. You were born to be a money master, and I'll teach you how.
X-Story Gold Mines, an NYSE Amex-listed company trading under the symbol XG, is slated to be the newest gold-silver producer in Argentina. X-Story is forecast to produce more than $250 million in bullion annually, beginning in 2013, at a cash cost of less than $200 for each ounce of gold produced. That forecast will make X-Story one of the highest margin operators in South America and a sector leader in the mining industry. X-Story has $50 million in its treasury, having spent over $60 million to date on drilling and engineering. The ultimate size of its Argentina discovery could be determined by year-end, as results from the 6 drills operating at the site are fully assessed. To find out more about X-Story Gold Mines and their exciting growth potential, click on their banner on the front page of TFNN.com or check them out on the NYSE Amex under the symbol XG.
Here's what people are saying about Tiger TV.
Let's go to John in Tampa. Hey, John, what's going on?
Hi, Tom. How are you, sir?
I'm doing great. You having a good day out there?
A wonderful day. I love your Tiger TV. I watch it every day. I'm like a kid in a candy store.
Oh, man, I appreciate you out there watching it. How long have you been watching the Tiger TV?
I'm watching almost a month now, and it's wonderful.
It's pretty cool, isn't it?
Oh, yes, it's cool. You see the charts and everything. Thanks so much for the hard work.
Tiger TV, a great news service from TFNN.com. This segment is brought to you by BackTech Environmental. For more information, just click the BackTech banner on the front page of TFNN.com.
All right, want to get right to this. We have a few more minutes with our very special guest today, Marianne Aiden. Now, Marianne, before the break, we were talking a little bit about sort of the bigger picture for the precious metals, and I know that you recently wrote a column for Market Watch. You do some great columns for Market Watch, and if folks haven't read them, they should. But where you did talk about the big picture for the gold market. Now, I put a chart up for the GLD up on Tiger TV. And, obviously still consolidating below that earlier high from several months back. But let's just talk about specifically what should investors be doing right now in terms of getting exposure to precious metals? What do you suggest as some actionable steps?
Well, actually, we think this is a good time to be buying, and I'll explain why. Is because really, if you go back a few months, gold had this huge run-up to $1,900 and some dollars, okay? Mm-hmm. And so a lot of people just laugh at that, and they go, well, it's so darned expensive. Right now, it's just too high. I'm not going to buy it. But in the meantime, it has come down. It's been up and down. It's been volatile. So then others, the naysayers, will say, well, it's so volatile, I'm not. And for some reason, and it just always gets kind of a bad rap, but the truth is it's consistently outperformed almost every other market for the past 11 years. Mm-hmm. You know, volatility or not, it has steadily risen. And if you look at it, you had mentioned charts, but if you look at a very long-term chart, that goes back even to the beginning of this bull market, which started in 2001, And if you want to go back even further to the early 70s, it's just been a steady, nice rise. I mean, it hardly shows much volatility. So, right, and then, of course, within gold's bull market, there are cyclical ups and downs. So right now, we happen to be in an oversold or down period. That doesn't mean it's going to go shooting straight up from here, but there's a good chance the downside, we're near the lows, and that would be especially the case if it can stay above, let's say, $1,600, okay? And if it does, and then the top side kind of resistance levels we're looking at are 1,700. If it gets above that, which is very close right now, that would be a first real positive sign. Then above 1,800 would be a very positive sign. And that would be the final sign showing it probably it then has a good shot at getting up to the old high of 1920, I believe it was. And then once it surpasses that, it's kind of off it goes again into new high territory. And, you know, and then our next question we're often asked is, well, then how high could it go? And basically the flip side of that is how low could the dollar go? Because it's just, again, we go back to all this money that's been printed and created, call it what you will, that's come barreling into the system, especially since the early 2000s, that is just carrying prices higher, and gold happens to be priced in dollars, and so it goes higher as the U.S. dollar falls, and that's going to continue. We see no sign of that happening until we see fiscal responsibility, which doesn't seem to be around the corner. So that's kind of, I hate to be so gloom and doomy, but that's kind of the way it is.
We have about a minute left, so just very quickly, and Marianne, this has been great. I wish we could talk longer. But how would you suggest should, for example, is an ETF the best way for people to get exposure? The actual bullion, mining stocks? What do you suggest?
Bullion, the 1 ounce coins, keep them in your possession. That's probably best. ETFs are fine. A lot of people will tell you no, but we haven't found any hard evidence to prove otherwise, and we recommend them ourselves to people. They're an easy way to participate in the up move. But, of course, having the real thing is better. And gold mines have been pretty disappointing. Although we recommend a few, they've kind of been underperforming the metal itself for quite a while. Eventually that's going to change, but it hasn't happened yet.
Right. Okay. There's our music. Marianne, thank you so much. I'm so thrilled you were able to take the time today. I'll have to have you back. All right. Have a great day. Everybody, stick around.
Welcome.
All right. Bye-bye. This is the Small Cap Roundup. We will be right back.
Folks, turns out my best student became my best teacher. Steve Rhodes absolutely raised my standards, and I'll guarantee he'll raise yours.
Thanks, Tom. What I've learned is that if you want more, you must become more, and that transformation, folks, that occurs the moment you decide to become a master. Now, the quickest way to mastery is through immersion, and for 2 solid days in Denver, Boston, and Tampa, I'll create a new standard of wealth for those few trader investors who have a burning desire to succeed. At my Master Trader course, I'll teach you how to create the ultimate money machine. These are the best-kept secrets in the business. Roadblocks, folks. Dabblers give up when they first appear. Stressors last just a little bit longer, but masters expect roadblocks and achieve extraordinary results when they bust right through them. I have all the benefit of knowing the type of wealth creation that I can generate for you. You don't. That's why I'm making this unconditional money-back guarantee. If for any reason you're not satisfied with my Master Trader course, I'll refund every penny. That's right. I take all the risk, and you get all the benefit. Go to the homepage at tfnn.com and sign up today.
Hi, folks. This is Tom O'Brien.
If you want to get great trade setups in the equity as well as the option market, come over to TFNN.com and test drive my daily newsletter, Market Insights, for 2 weeks absolutely free. Each trade setup comes with a profit projection as well as stop placement. Included in Market Insights is a Twitter alert service. This allows you to take advantage of intraday setups. Volatility is back in the markets. What does that mean to you? To me, it spells short-term opportunity each and every day. The days of trending up on lighter volume are gone. We have come off the highs with volume across the globe. Don't get caught in a complacency trap. Many of the indices have given back 2 months of trading in 1 week. We have a trader's market. You can take advantage of this trader's market by test driving my daily newsletter, Market Insights, free for 2 weeks. Market Insights will give you the edge you're looking for in the markets. Go to TFNN.com under newsletter. Hit the Market Insight tab for your 2-week free test drive right here, right now.
In the world of financial markets, there's a new player in town with an exciting new way to trade the markets. Nadex now offers binary options as well as bull spreads in a wide range of indices along with commodity and forex markets. With as little as $100, you can gain access to a new way to trade global financial markets while guaranteeing that your risk will always be capped. Nadex allows you to multiply your trading opportunities in ways never imagined before and access markets you once thought were out of reach. With short-term trading opportunities available, including binary options expiring each hour the market is open, Nadex allows you to take advantage of a variety of market conditions regardless of volatility or market direction. Now is the time to take advantage of this exciting new market. Don't let this trading opportunity pass you by. Open your account today by clicking on the Nadex banner on the front page of TFNN.com. Nadex, a better way to trade.
What type of investor are you? Conservative, moderate, or aggressive? No matter your investor personality, your overall portfolio should reflect your financial goals, time horizon, and your risk tolerance. Help ensure your portfolio is appropriately invested with an asset allocation plan from Morgan Stanley Smith Barney. Simply picking the right stocks is not enough. Research has shown that choosing the right proportion of stocks, bonds, and cash is essential to the success of your long-term investments. Morgan Stanley Smith Barney believes that a carefully selected portfolio can lower volatility and increase investment return potential. Find out about what asset allocation and a Morgan Stanley Smith Barney financial advisor can do for you. Call Angela O'Brien, First Vice President and Certified Financial Planner of the Clearwater, Florida branch at 727-441-6108 today to discuss your personal financial needs. Asset allocation does not assure a profit or protect against loss in declining financial markets. Investments and services are offered through Morgan Stanley Smith Barney, LLC. Member SIPC.
This segment is brought to you by Harmony Gold. For more information, just click the Harmony Gold banner on the front page of TFNN.com.
Welcome back. This is the Small Cap Roundup. You know, I said up front at the beginning of the show, if you were around, you were listening. I'm Kate Stalter, by the way. I'm your host here. I don't even think I've introduced myself yet today. Just been so thrilled that we have such a roundup of great guests today here on the Small Cap Roundup. You know, I said up front that we were going to talk about a theme today, being how to look at the small caps in the context of the broader market with various asset classes. I thought our conversation with Marianne Aden was exactly to that point. And we have another guest on right now that I'm thrilled to have joining us, someone I've spoken with before. Sam Didio is head of U.S. equities at Ardio Global Management. And Sam, I really enjoyed our discussion a couple months back when I interviewed you for Money Show, and I was very excited to be able to get you back on the show here at TFNN today. Now, I know before we had talked about some mid-cap names, some recent IPOs. You have a great perspective on some less well-known stocks. So I was wondering if maybe you could talk a little bit, just for starters, about how people should view smaller caps in the context of the broader market.
Sure, and thanks for having me on the show. It's great to be back, and I certainly love your intro music. I'm a big Tom Petty fan, so
me too. Yeah.
To hear that. When you look at the small cap universe and you start to go down into the micro caps, which we define as, companies below $1 billion, certainly they're less researched companies. And because of that, they generally just have more volatility because there's just less sponsorship in the companies. There's less liquidity. It doesn't take much to move a stock up, move it down. So as you start to look at that asset class as an investor, you have to say to yourself, I need to be risk tolerant. I need to accept the fact that, a company may have a news item or a competitor might have a news item, and the stock might react positively or negatively in a way that causes the stock price to move more than average. And you have to accept that. That's really one quality of the asset class you need to accept as an investor if you plan to invest in it. So you have to have the stomach. You have to have the stomach for the volatility. The second thing is, often in this asset class, the companies can continue to go up because people, investors, and analysts that cover the space don't appreciate and don't have perspective or the proper perspective on the opportunity set. So they'll grossly underestimate how well a company can do and how big the market opportunity could be for a company. And the stock continues to go up, and the valuation looks expensive, but then you find out that the product or service that the company is selling is really being introduced into a new market opportunity where the total available market for a company's product is much bigger than you think, and they continue to have rapid sales growth, which delivers a greater potential for operating margin improvement. And then before you know it, the earnings power of the company is underestimated, and they have these wicked earnings surprises for multiple quarters, and that's why the stock looks expensive. When you rewind the clock a year back from this great run a company has, you say, aha, you have your aha moment why a company was so expensive at the time, because the market was discounting that great things were ahead of it. So sometimes you have to let your horses run and ride the momentum a little bit, but you need to maintain diversification in the portfolio too. I'm a big believer in that as well.
Right. So literally not putting all the eggs, I guess, so to speak, in one basket, really to have different types of asset classes, market caps, et cetera, in one's portfolio.
Right. In the broad context of an individual investor's portfolio, certainly need to have some large caps, some mid caps, and some small caps. And depending on certainly on a lot of things, including your age, the amount of money you have in fixed income investments, that will determine how much you'll have exposed to equities. But I do believe if you look at the long-term averages and you look at the return of small caps going back to 1926, you see there's a big, about 200 basis points of outperformance for the asset class relative to large caps. That's just simply looking at U.S. equities. And then if you go down and drill down a little further, you see that micro caps actually do a little bit better than small caps. However, the price of admission to that great return, almost 12% annualized, going back that far, is the standard deviation or the volatility of that subset of equities is very high, and the stocks move around a lot, they bounce around a lot. You can't get thrown off the horse if you want to be exposed to the potential of those great returns. So it takes some risk tolerance, but if you're diversified in terms of your asset allocation, you should say, you know what, that comes with the territory. In the long run, this usually works. Then you just have to find decent managers that can navigate the asset class and deliver returns that are in line with the benchmark. And if you're not comfortable with an active manager, and this is something that each individual has to determine, you can be exposed to the asset class through active investment strategies like ours, or a passive index.
Now, I want to follow up a little bit on the volatility and this idea of how much tolerance an individual has. A lot of our listeners are, at least partially, managing their own portfolios when it comes to some of these discretionary trades. So when an individual investor or trader is looking at some of these smaller companies, how much of a drawdown do you think is advisable to tolerate before you say, okay, I'm out of here, I'm cutting my losses?
Right. Well, each person, because of their risk tolerance, will have a different answer for that. I can only tell you that when I manage our strategies, what I try to do. And we pride ourselves on our team at RDO and our microcap and our small cap funds to get very good entry points in our stocks. We never always get great entry points. We get in and the stock never goes down more than 5-10%. It's a dream. But what we try to do is try to understand what the reward to risk is, and we try to find 3 or 4 units of upside to 1 unit of downside over a 1 to 2 year period. That's our mantra when we look at especially in the micro and small cap universe. And the rule of thumb I have is if it's an illiquid micro cap or small cap, then the reward to risk needs to be even greater, because it may take us more than a day to get in and out of a stock. And typically, if there's a problem, the price will usually deteriorate, and it'll be even more painful to get out of the stock in terms of the price action. So you can lose more money over time, is my point, when something goes wrong. So you have to have, in those cases where there's illiquidity, sometimes 5 units of upside potential to 1 unit of downside risk. So you have to look at the outlook for the company. You have to look at the earnings power of the company. You have to handicap yourself as an investor. Does it make sense? The common sense thing we like to ask for any company we look at is, does the company have a product or service that's going to change the behavior of the spender? And we fall back on that every time for every company we invest in. And if the answer is yes, then we look at the sales growth opportunity for the company. We look at the competitive landscape. Those things will really determine the gross margin potential for a company. And as a rule of thumb, you should look at companies with higher gross margins and also high operating margins as a rule of thumb to dictate the competitive landscape. Another thing that it's important to do is to look at the operating margins in isolation. And if a company is just about to see a J-curve or an inflection point in sales growth and the operating margins are low, that's nirvana for us, because we think that at that point the operating leverage in the business will allow it to see significant improvement in operating margin and be able to have significant upside surprises to earnings and have the earnings explode. And then with that, you typically have higher valuations because the earnings are higher, and you also get multiple expansion. You get a higher PE or price to EBITDA multiple, and that's how you really make money in microcaps and small caps, to get on board a story that starts to see multiple expansion. And that's really what we try to find. But the investors have to maintain diversification. So you should have a company in tech, you should have a consumer discretionary company, an industrials company, a healthcare company. Maintain that diversification within the small cap arena, and I think your investors will be well served.
Let's talk a little bit. You were alluding to a couple of the funds that you do manage, the microcap, the small cap. Give us the tickers of those, if you don't mind, Sam, and then maybe we can talk a little bit about some holdings in each. We have about 5 minutes left.
Sure. Our microcap fund is JMCAX, the RDO U.S. Microcap Fund, and our small cap fund is JSCAX, and that's the RDO U.S. Small Cap Fund. And when a couple of examples, I'll give you these are mostly growth-oriented companies. And typically in microcap and small cap, I would encourage your investors to look with a bias toward growth companies, because there's so many companies at this capitalization level that do have real growth potential. And turnarounds are tricky and are typically long duration and would really test the patience of the average investor. But I'll give you a couple of examples of companies we like over the next couple of minutes. 2 are in technology. 1 is in consumer discretionary. First, starting with consumer discretionary, a company called Tivana. It's a $700 million market cap company. Went public last July. Higher multiple company. Earnings growth significant. Sales are compounding over 40% over the last couple of years. Will probably decelerate to the mid-30s as you look out the next couple of years. Significant operating leverage. Operating margins are improving. Very profitable boxes. But Tivana, to get to the point, is a retailer of fine teas and tea-related merchandise. So basically, they sell serving sets of tea, the hardware, and the tea, the loose leaf tea, is actually the software, or the razor blade model. And they have about 190 stores now in the U.S. We think they could probably get to 500 or 600 over the next 4 to 5 years. And they have one of the highest operating margin profiles of any specialty retailer. Very profitable stores. And what I like about it is I think they're exploiting a niche that hasn't been served in the U.S. so far. Starbucks has been a great purveyor of coffee. There isn't a pure play tea company, and tea is the second most consumed beverage in the world behind water. So I think the U.S. is behind the consumption rates of a lot of the other countries like the UK and Ireland, which are on top of the list for per capita consumption of tea. And we think
behind
that the US
China even.
Yeah, I think the U.S. is number 22. So there's significant potential for that to expand. And I think the focus on health and wellness would also create a greater awareness of the category.
Now let me ask you, because I'm looking at just I put a chart of this one up on the Tiger TV so our viewers on there can see it. Now, I noticed some terrific estimates in terms of earnings growth on the next couple of years of this company, and I had noticed this previously because I do track recent IPOs. What's going on with it right now, Sam, that we're seeing a bit of sell-off in the past couple of months?
Sure. I think, full disclosure, there's an earnings report tomorrow. So investors should look for that earnings report, and I would encourage any investor that would consider to invest today to also average in. Don't buy it all in front of the earnings tomorrow. Maybe buy a little today, look at tomorrow to see what happens with an update. I think the Street's been disappointed with their comp store sales. I think they expected to have just a higher number since they've gone public, and they haven't delivered a stellar comp same-store sales comp number. And I think that the management team understands this well. And I think as you look at the balance of this year, especially into the second half of their strong quarters, the fourth quarter, they're going to spend some investment dollars to improve their online sales. It's currently only 8% of retail, and for the average retailer, once they understand and perfect the model, it's typically mid-teens. So I think there's a lot of potential for them to improve their online sales, which is actually very profitable. And that would allow the margins to improve and allow the earnings surprises to continue and to probably be greater. So I think the Street's been a little underwhelmed with the same store sales comp numbers, and I would expect to see that improve. The other thing too, keep in mind, it's the first quarter of the calendar year, and often companies do set the bar low in terms of expectations. So with a pure play growth company, that would not surprise me. And with the rest of the year in front of them and an improving economy, I think they could really be positioned to beat and raise as the year unfolds.
Okay,
so
we've got less than a minute left. Give me one more ticker and just a very quick summary.
Sure. Easy Chip, CH. Semiconductor company specializing in the local area network market where there's a lot of congestion and contention with everyone using smartphones to get on the internet. We think it's a great play, gaining market share. They sell their chips to Cisco and the leading networking companies who no longer really design their chips internally. They outsource to Easy Chip. Among the highest gross margins in semiconductors, around 80%, operating profit margins north of 40%. Tells you it's a very differentiated product with very little competition and very high growth rates due to congestion and contention.
Yeah, nice chart and nice estimates. Sam, thank you. This time just flew by. I'd love to have you come back on the show again some other time, and thank you so much for joining us.
Sure, my pleasure.
All right, take care. This is the Small Cap Roundup, back with one more segment. I'm Kate Stalter. Stick around.
Put the power of the Chapman Wave methodology to work for you. No matter what market you trade, what time frame you trade in, or your trading style, the Opening Call, Basil Chapman's daily market newsletter, is bursting with the information and trades you need to become a more successful trader.
I've been using Basil Chapman's Chapman Wave methodology for several years now. His Chapman Wave can be used for any time period for not only equities, but futures, currencies, commodities. I've been also a subscriber of his Opening Call, which I find is an invaluable tool to help me analyze the potential of the market each day. He gives you opportunities to go short and long. It includes recommendations on stocks. I strongly recommend people using the Chapman Wave, and I very, very strongly support the use of his opening call.
To find out more about Basil Chapman and his Chapman Wave methodology, and to get your 2-week free trial of the opening call, a $64 value, visit tfnn.com today.
In just December of last year, the price of gold was down over 10%. In today's highly volatile gold market, you need someone in your corner that understands the complex relationships that exist within the price of gold, as well as within a variety of gold equities. Whether it's the South African gold miners and knowing how the Rand-dollar relationship will affect their bottom line, or understanding how John Paulson's $5 billion trade in the GLD can move the market, Tom O'Brien gives you the direction you need to become a better trader each week in his newsletter, The Gold Report. With over 20 individual equities covered and almost another 20 on the potential watch list each week, in addition to covering the XAU, HUI, GLD, and dollar, The Gold Report is a great source for any trader that is looking to be diversified in today's volatile gold market. For your 30-day free trial to Tom O'Brien's Gold Report, log on to tfnn.com today. Don't miss out on this great offer. Act now. David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to tfnn.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today. Great Basin Gold is a mining company engaged in the exploration and development of 2 emerging gold properties in Nevada and South Africa with a total resource base of more than 23 million gold ounces. Great Basin's Burnstone mine in South Africa opened in February of this year with a resource of 20 million gold ounces, becoming the first mine to open in the historic Witwatersrand Basin in the last 30 years. The Burnstone mine is projected to have a 25-year mine life and is fully financed, with production anticipated to be over 250,000 ounces per year at a cash cost of only $450 per ounce. The Hollister mine in Nevada became fully integrated in the 4th quarter of 2010 with annual production estimates of 110,000 ounces of gold per year over the 8-year mine life at a cash cost of only $527 per ounce. Great Basin Gold is cash flow positive and trades on the Toronto and New York stock exchanges under the symbol GBG.
This segment is brought to you by TFNN. Test drive all the newsletters for free at tfnn.com.
Okay, last segment of the show today. We had our theme show today, putting the small caps in the context of the broader market. A couple of great guests explaining that. I want to remind everybody, we've got the Options Hour with Victor Jones. Comes up at noon Eastern today. You don't want to miss that. Ben from Tallahassee, thank you for being patient and sticking around. You had a question about the IWM, I understand?
Yeah, hi, Kate. Can you hear me okay?
I can.
Okay, yeah, great. I know we got a few minutes here. I just wanted, from a chartology, I guess you call it, standpoint. Yeah, that crazy word.
I like that.
Yeah, over the next 12 months, just wanted to, I don't want to dig into the 1,000-foot, below the earth here standpoint and all the gory details. I was just asking. Over the next 12 months, do you see this being? Are we part of a bull phase in an overall bear market, or do you feel we're off to the races with the kind of the normal bumps in the road in the dips to buy more?
Okay. First of all, I want to disclose, I actually do own the IWM a small position in one of my brokerage accounts. So I should say that if I'm going to be talking about this. Ben, it's a great question. It's something that people wonder about. I avoid the 12-month views just because there are, so many of these quote-unquote black swan events, and that's really a misnomer these days because, there are so many macro world events that can just throw the markets into some kind of tizzy that nobody expected. I'm looking at what's going on right now. The chart is a good one. I've put up a daily chart on Tiger TV, and I'm going to update that to a weekly. Either way you look at it, it's pretty good. It's holding up nicely above that 50-day moving average. You have had a little bit of last week. You had some heavier volume to the upside. So just, to use your word, which I like, to use the chartology point of view, right now it's acting nicely, and there's no reason that I would consider getting out of this trade at the moment. But as always, I'm just watching what is the market actually telling us. Similar, I think Marianne Aiden actually said that earlier in the show, and I'll apply that remark to this particular chart. If you see some signs of heavy volume selling, if you're looking at some kind of drawdown relative to your entry point, then get out. I mean, there's no reason this has to be a long-term buy and hold thing. No reason at all, really. Is this something you're in right now, Ben?
No, I'm not. I unfortunately missed the last 4 months, and I was just, I'm just trying to, and I tried day trading the last 5 years, and I think I've lost more hair in my head than I've ever had in my life.
It's tough, yeah.
So, I'm sure some people have done it really, have been very successful. I just haven't, and I've tried so many different methodologies. I'm just trying to go back to the good old-fashioned trend trading, kind of
right.
Like where the month-to-month swings going, and I'm really kind of hoping that at some point here we'll get a nice big burp in the system to get back in. But I just wanted to get your viewpoint. I know where Tom's head's at, and Ken and Basil, I've heard a lot of them. I was just kind of curious where your viewpoint is on if you feel there's a big burp coming, or if you feel that hey, I think we've been through the worst, and it looks pretty positive moving forward.
At the moment it looks positive, but who the heck knows what kind of news somebody somewhere in this country or overseas is going to come out with next that's just going to put the scare into the market. But right now, I would say this one's in buy range. Hey, Ben, thank you. Right. So glad to talk to you. Call back some other time. Would love to talk to you again.
Okay.
All right, everybody, thanks so much. I want to thank caller Ben, our guest Marianne Aiden, and Sam Didio. Terrific conversations today. Stick around for Victor Jones. He is up next. I'm Kate Stalter. This has been the Small Cap Roundup.